Welcome back to the Bitcoin Layer. Today we'll be discussing why the demise of the dollar narrative is a little bit too sensationalist, and it's been going on for several decades now, and we'll explain why it's misguided. To kick things off, we invoke the infamous quote of Mark Twain when his death was falsely reported, where he famously said, "The reports of my death have been greatly exaggerated. The reports of the dollar's death have similarly been greatly exaggerated." The US dollar as it stands right now is deeply entrenched in global financial plumbing. And here at the Bitcoin Layer, we recognize the role of the dollar and its prominence within the world at large, not only being the largest and most liquid fixed income market in the entire world, but also having global interest rates really bend at the whim of US dollar financial markets, whether that's the Federal Reserve setting interest rates and also the variety of US Treasury interest rates as well. So for now, the notion of China or Russia imminently dethroning it are really a far cry from reality, if nothing else. We're going to put a quote up on the screen here. This is an excerpt from a New York Times article that came out following Nixon's departure from the gold standard in August 6, 1971. And the quote reads that Arthur M. O'Connor, he was the chairman of the Council of Economic Affairs under President Johnson, and he said he could not say to what degree other currencies would rise in value relative to the dollar, but he was certain they would rise. And so this narrative is nothing new, this notion of a dying dollar because it hasn't been pegged to gold or whatever other reasons, right? Rampant inflation, horrible fiscal and monetary policy, all these other things that have been used to sort of bash the dollar and bash the people who sort of set the price of it in US dollar capital markets and how hegemony is so bad for the world. This idea has been pervasive across the globe that the dollar is going to die. Well, if you take a look here at the US dollar index over the last 50 some odd years, 55 years now, back since 1968, this chart goes back to, you can see that the dollar is essentially flat, right? Ever since that post-Bretton Woods era where we've essentially allowed the dollar to fluctuate freely against gold, and with that basically allow for, now going on 52 years of price discovery for global currencies, and the dollar remains king of the universe, right? When it comes to currencies, half a century later. Right. So the US dollar, even after departing the gold standard, which many would think would cause extreme capital flight, it didn't. Right. And largely that's a component of the liquidity profile of the US dollar that it was imbued with in the 30 years moving from Bretton Woods to the departure from the gold standard. Right. Basically, all of this global financial plumbing had retrenched itself around the dollar after World War II, which was sort of a global monetary reset. After all of these countries had engaged in war, they really came together, at Bretton Woods in New Hampshire in order to discuss what the new monetary order would look like. And that's essentially why the US dollar had the ability over 30 some odd years till 1971 to really gain the traction and gain the liquidity profile that is basically it's benefiting from today. And we'll talk about that a little bit more. So the US dollar is globally entrenched to the nth degree. Again, it helms the deepest and most liquid fixed income market in the world, which means, it provides securities that receive a healthy structural bid from basically every capital allocator who has dollars on their balance sheet, both sovereign and non-sovereign. So even as we talk about this great sovereign debt bubble bursting, which is another narrative that we don't necessarily agree with here at the Bitcoin Layer, you still see a continuous bid from emerging markets and capital allocators just generally around the world, particularly from G10 nations, Europe, Japan, the United Kingdom and Japan. They continue allocating capital to U.S. treasuries en masse, right? Despite this notion of the death of the dollar and this extreme divestment from U.S. treasuries, you have to look a little bit harder beyond the headlines in order to recognize what's actually going on here. And the reality is there's still a very, very strong structural demand for these instruments at home and abroad particularly. So lending is collateralized by dollars and dollar-denominated assets, particularly U.S. treasuries. Foreign nations and their businesses purchase them, and world interest rates bend at their whim. Uprooting this critical financial infrastructure would not only be lengthy, costly, and disruptive, but stepping aside from all of that, the US dollar currently works for what it was intended to do. There's no clear reason for another national currency to displace the US dollar as the world's primary reserve currency. Now, again, this goes against the grain. This goes against the grain because people will, they'll point to inflation, money printing, all of these clips of central bankers, particularly in the United States, post-great financial crisis, all of the debauchery that they've caused, and they'll say, how could the US dollar still be in the position that it is? And the reality is, it still functions for what it was designed to do, and that's lubricate global trade and financial markets with deep enough liquidity. With all this in mind, today we beg the question, will the real dollar replacement please stand up? And essentially what I'm doing here is going through a Substack that I wrote earlier today that can be found at thebitcoinlayer.substack.com. Basically, you can get all of my thoughts in written form there, and also I do an audio narration. So this is now my third time going over the material today, but I do want to present it to our viewers over at the Bitcoin Layer YouTube channel. So that's what I'm doing. And the origin of these ideas are not only our own here at the Bitcoin Layer, but also those of Michael Pettis's on his recent Twitter thread. You can find that in the link below in the description. So the first thing we're going to talk about, de-dollarization, right? This sort of notion that's been floated around for several decades at this point, as we said, mentioned in 1971. The term itself has come about within the last decade or so. It's actually looking more like re-dollarization, right? This notion that, central banks are divesting en masse from treasuries. Certainly some are, but on the other half of the spectrum, emerging markets, other capital allocators, they have no problem scooping those up. When it comes to foreign exchange reserves, which are the assets that central banks hold on their balance sheet, and they utilize them for several things, particularly two things: foreign exchange defense. So when your currency is getting devalued, you have assets denominated in another currency to defend the value of your own. Pretty simple. And the second is global trade, right? Lubricating global trade. And the US dollar and dollar assets, like US treasuries, they compose the majority of global FX reserves. The majority of the assets used by central banks and held in their balance sheet in reserve are US dollars and dollar assets, because any way you slice it, that's how global trade works. That's how it functions. And essentially, and I'll mention this again later, but trying to sort of uproot all of the world's financial infrastructure. It's not like pulling out a video game cartridge, blowing on it, and then putting another one in. It's not how it works, right? These relationships are so complex and so convoluted, that it would be near impossible to do this without extreme disruption, right? It's like trying to replace a plane engine while the plane is still in flight. And as of right now, if both engines are functioning fine, sure, there's some sputtering here and there. It's not the most comfortable flight, right? Particularly for citizens who are very battered by inflation. In other poor fiscal and monetary policy decisions that sometimes we have here domestically, they're much worse elsewhere, right? So it's a rather bumpy flight, but it's sort of nonsensical. It doesn't make sense at this current moment in time to begin replacing the engines while they're still functional. Now you could take a look here at this chart. This is allocated reserves by currency for the third quarter of 2022. As you can see here in the deep blue, the United States dollar reigns supreme, and then the Prince Euro also is right there. So dollar is king, the euro is prince, and then everything else takes up a relatively small slice. Now we'll talk about nations who are sort of adversarial when it comes to US dollar hegemony, and they're trying to, or hegemony. You say hegemony, whatever. I suppose it could be pronounced both ways, just to save face. But there are two nations that are really sort of challenging this right now. One of them is Russia. Right? We've heard Russia, terrifying, whatever. They're one of the two major adversarial nations, along with China, that are trying to circumnavigate this US dollar hegemony. They want to break from the need to use the US dollar for international trade. And in 2018, it sold virtually all of its treasuries, and it's been steadily accumulating gold instead. As you can see here, this chart on the screen, Russia's U.S. treasury holdings have dropped to virtually zero. They went from owning hundreds of billions to now just 2.1 billion. So basically chump change. So obviously this was a somewhat wise decision, right? It sort of insulates Russia from the freezing of foreign exchange reserves, U.S. treasuries particularly. It didn't stop other nations from freezing its central bank FX reserves. In fact, Russia custodies the majority of its FX reserves outside of its country. And as a result of that, the majority of them were frozen after it invaded Ukraine. So despite selling all of its U.S. treasuries, it still wasn't able to escape sort of this idea of Western economic sanctions. It was also cut off from SWIFT. So interbank transactions, you can't do any messaging into or out of Russia as a bank. Sort of these impositions that were created by the war onto Russia from Western nations. And as of right now, you could see down here, they've been accumulating other FX reserves, right? It's not as if, all of them have gone away, just U.S. treasuries. You can see here, they still have a total of $594.6 billion in assets, a large part of which have been frozen by the West. The whole move here with Russia was divesting from the US dollar, becoming less reliant on it. But wait a second. If we take a look at the amount of dollar-denominated assets they have on their balance sheet, they still have 16.4% of their FX reserves denominated in dollars. That's strange. I was under the impression that by selling US treasuries, it was a statement to the world that they no longer needed the dollar. But by this account, they clearly do. Right? As I said earlier, and as I'll say several more times, if you want to trade, it's going to be in dollars, whatever way you slice it. We're going to talk about some of the coalitions that are coming up that are trying to circumnavigate that on a several country level, right? Trying to create a new form of globalization, a new form of international alliance that has nothing to do with the U.S. dollar. But as of right now, it's still in its very, very infant stages, and saying that it's going to imminently displace the dollar is sort of a misguided idea. So Russia sold all of its U.S. treasuries, but despite that, it still has a dependence on U.S. dollar-denominated assets in its foreign exchange reserves, right? In order to sell what it produces and purchase what it needs, dollars are an absolute necessity. It's a very tall order to stop using the world's primary settlement currency when you're one of the only ones abstaining from it. And therein lies the problem for other nations who are attempting to do the same, like China, who similarly wants to move away from the dollar and begin using its own currency, the yuan, also known as the renminbi, to facilitate trade to and from, and it wants to do the majority of its international trade in yuan. So China's central bank has a little bit more voting power here. They have a staggering $3.127 trillion in central bank reserves, central bank foreign exchange reserves, rather. That is the largest foreign exchange reserve in the world at the PBOC, the People's Bank of China. Not so much the People's Bank now, is it? That's a communist country. Anyway, compared to the U.S., naming conventions, right? But compared to the U.S., it's extremely large. The United States only has an FX reserve pot of $247 billion. So obviously, China has a huge amount of FX reserves, and that's just the natural byproduct of being one of the largest centers for global trade. You need to have a lot of assets on hand to lubricate that trade. And despite China's slew of incentives to break free from dollar hegemony, a substantial portion of those assets, just like Russia, still need to be dollar denominated. Right? As you can see here on the graph, China's U.S. Treasury holdings, despite attempting to sell them off, it's still got a hearty $870 billion on its balance sheet. And sure, it has winded them down, but ultimately, it's going to fall into much of the same trap that Russia has, right? Regardless of whether you'd like to deal in dollars, if you're going to grow as a nation, you need to be utilizing the currency that's embedded across all of global finance, especially in China's position, right? Being ravaged economically over the past 3 years with its zero COVID policy and its demographics that mean it's going to shrink as a nation over the next several decades. And so it's very incumbent that China plays ball. China plays the dollar game. But as of right now, China is backing itself into a corner. Its position as the largest holder of FX reserves unintuitively makes it actually more reliant on the U.S. dollar and that the U.S. dollar sticks around for international trade. Because obviously it holds an obscene amount of U.S. dollars on its balance sheet. It's the primary composition of its balance sheet. And again, if you want to purchase what other people have and you want to sell what you have, you need U.S. dollars. And for a country like China that needs that growth, that needs that excess growth in any way possible, with your demographics absolutely waning and your economy very, very teetering on the edge essentially right now, the position that you don't want to be in is the position that they're in currently, which is essentially trying to grow less reliant on that system that they need in order to grow. So loose fiscal and monetary policy in the U.S., despite everyone's best estimate, has not created an exorbitant loss of faith in the dollar or a mass exodus from dollar capital markets, as some have suggested. To the contrary, there has been no de-dollarization. Over the last 2 decades, the proportion of global FX reserves denominated in dollars is flat. You can see the first chart here, the world currency composition of FX reserves. Obviously, you see US dollars, euro, renminbi, yuan, pound sterling. They're all growing throughout the last 23 years. But if you look at the second chart here, the world currency composition of FX reserves broken down by a percentage, on a percentage by percentage basis, essentially what was occurring from 1999 to 2014 roughly was that as nations divested from the dollar, they weren't necessarily allocating into other currencies per se. Some were purchasing hard assets like gold, and some were leaving their reserves just unallocated, right? They had these reserves that were denominated in their own currency. They were unallocated reserves. And beginning in 2014, we've seen net buying of US dollars into foreign exchange reserves by central banks. Despite Russia despite Russia completely dropping all of its foreign exchange dollars from its foreign exchange reserves and dollar assets, despite China working to do the same very regularly, you could see here that other nations are happy to pick them right back up from China and Russia. And China and Russia themselves can't divest from them to the degree that they need to, because the harsh reality is, if you want to trade, it's going to be in dollars. If you want to not sacrifice your productivity on the world stage and sacrifice your ability to grow at the pace at which you were, which neither of these nations seem willing to do, at least China has for the last 3 years, then dollars are the game that you have to play. And emerging markets understand this. They've been some of the largest bidders of U.S. treasuries over the last several years. Japan understands this, apart from the last several months of net selling as it defends its own currency peg, with the yen being extremely devalued. And most of Europe understands this. The United Kingdom understands this. Every nation that's very serious about growing economically knows that they need to have dollar assets on hand, and they need to continue accumulating them, at a relatively steady rate in order to be viable in the capital market game. China and Saudi Arabia's ever-present trade surpluses, right, year after year, they don't matter, right, necessarily. They're net producers, but ultimately, what are other nations going to buy their product in? Their goods, their services, their commodities. They're going to buy them in dollars, regardless of domicile, right? Regardless of where these purchasers live, which means that nations must hold US dollars and be active in US dollar capital markets. They got to play the game. Whether we like it or not, we live in US dollar hegemony. And proponents of the dollar's demise will most recently point to Xi Jinping's visits to Saudi Arabia and talks of purchasing oil and paying for it with their renminbi, again, as a signal of the dollar's demise. But with China being the largest oil importer, obviously this seems like the most substantial news of the 21st century. And while it's not nothing, right, the notion of imminent displacement of the petrodollar, which is this national currency regime of paying for energy products in the dollar, it's misplaced, to say the very least. Both nations run current account surpluses, right? And they need to continue purchasing securities from the U.S. and other current account deficit countries in order for the global balance of payments to balance, right? This is a necessity. There needs to be this bid from nations who have capital account surpluses into securities from nations who have capital account deficits, current account deficits rather. And the United States is the beneficiary of all of that. We run a structural current account deficit. We have for several decades at this point. And that's because of the position that we're in and what the US dollar is. The world reserve currency needs to be a currency of a nation who has the ability to weather and stomach the persistent current account deficits. And that's what the United States does. And also proponents of de-dollarization will similarly point to Russia's move to accept yuan for oil as cannon fodder for the petro yuan, right? But it's disingenuous, to say the very least, as it was likely, it was less likely a voluntary move, right, to build the new world order, new currency regime. It was likely bred out of a state of necessity, right? Obviously, all of the Western world completely ceased purchase of Russian crude following its invasion of Ukraine. This means that Russia is not at all in the driver's seat in this trade deal. It just needed to sell its oil. And China was willing to purchase it at a discount so long as Russia purchased it in yuan. It just needed to sell its oil, right? The move to accept yuan for oil was more so out of economic necessity. It shouldn't be taken as a sign of the shifting tide towards the yuan as a US dollar replacement. Right? In reality, the yuan accounts for a measly 2.88% of global FX reserves. Right? Very, very small. Not nearly deep and liquid enough to settle a fraction of the global trade that the US dollar settles every single day. And as I said before, you don't change the engines on a plane when you're in mid-flight. Nations simply won't drop everything and shift gears into another currency that's barely liquid to sustain daily trade volumes without wild volatility, right? And they're certainly not going to do that without pumping the brakes on economic growth around the world, and that would be extremely disruptive. Not to mention the yuan is not a fully convertible currency. It doesn't trade freely, right? The Chinese government restricts yuan activity. Its capital account is locked, right? You simply can't have a currency such as that as the world reserve currency, as the largest world reserve currency, the primary one rather. So really this dollar replacement is something of a Mexican standoff, right? There are several different countries that want the dollar spot, but they have no reason to cooperate with one another. Every single one wants to be the world reserve currency, right? People talk about the BRICS alliance between Brazil, Russia, India, China, South Africa, right? All these emerging markets that are, sort of attempting a coalition to bring about a new monetary order. But in actuality, there isn't a reason to cooperate among any of these individuals, right? They all want the spot that the dollar has. The reason they want to exit the dollar is because they want to be in the position that the dollar is. They don't want to create a US dollar 2.0, right? Brazil doesn't want to kowtow to China with the yuan. Brazil wants its own currency to be the world reserve currency. Right? These countries aren't cooperating out of a need to exit the dollar. They're cooperating, quote unquote, because each of them wants the spot that the dollar has, and that can't work. It's a Mexican standoff. It's really BRICS in its current form is basically sort of like this ant farm form of globalization, right? The U.S. All around the world, global trade is so deeply interconnected, and BRICS is sort of like an experiment to see if that can occur outside of the U.S. dollar's purview. But again, this is a Mexican standoff, right? There's no clear strategy for an individual country to achieve victory over the dollar in the absence of cooperation, of which there is none. Of course, it's still in its infant stages, but as of right now, this is the terrain, right? And a lot of this video is extremely contrarian. But again, we want to give it to you how it is, and we want to tell you the reality that the United States dollar is king, and chances are it'll stay that way for quite some time. Every major international currency throughout history has been issued by a political democracy of some kind, right? And a basket of currencies backed by commodities, in our view, like BRICS is proposing and China is proposing, and China and Russia are sort of subliminally imposing that through purchasing gold reserves and sort of pseudo backing their currency with a hard money. In our view, it's not a suitable replacement using history as our judge. Nor are the ruble and renminbi because of their issue stringent capital controls, as spoken about previously. Now, we do view Bitcoin as a sensible alternative as a base layer reserve asset that'll achieve adoption as an international settlement rail over the next several decades. We've written several articles about that over at thebitcoinlayer.substack.com, which is our primary source for all of our markets research. We also have this YouTube channel to put some of that in video format like we're doing today, but we've spoken about this several times. And through the years, Bitcoin as a settlement layer has improved, settling last year over $8 trillion processed by the Bitcoin network last year. Obviously, that doesn't hold a candle to other monetary networks, Visa or let alone Swift. But again, it's growing exponentially year after year. And with technologies like the Lightning Network, that's proliferating even further. And that's why we talk about it so ardently. We talk about traditional finance because it's important to know what is going on in macro. And today we're talking about global currency regimes because Bitcoin exists in a universe of other assets and other factors. And that's why we talk about it. And that's why we want you to understand it. But also, Bitcoin is readily monetizing in the background. And this is one of the areas that Bitcoin really shines. Any dollar replacement would also need to be large and liquid enough that its daily fluctuations, obviously due to trade settlement, aren't disruptive to the nation's economic activity. And thanks to the dollar, otherwise the issuing nation would back away from the role of being the world reserve currency, the primary world settlement currency. And today, the US dollar is the only currency that fits the bill, right? Relaxed capital controls, a persistent current account deficit, and a large enough liquidity profile to weather volatility storms while keeping critical financial plumbing intact. The dollar is the only thing that has those three things. Do we do threes like this or threes like this, threes like this or this? Doesn't matter. The dollar is entrenched, right? Is what we're saying. The unique confluence of circumstances has allowed the dollar to exist in the way that it does. And as the world decentralizes, as it deglobalizes, as it's currently on track to doing, so it seems, it'll become more, not less entrenched. Right? This is because of the relative neutrality of the dollar. We described the adversarial dynamic between countries above. No nation is going to accept another nation's small, relatively illiquid currency because it narrows the options available in US dollar financial markets. Again, this thing is entrenched. People are going to accept dollars even as the world deglobalizes. That's generally the idea. The dollar remains default because it's perceived as neutral in a decentralizing world. Additionally, the idea that a group of countries, all of whom have different interests, can displace the dollar's position is a stretch, right? This is why we have one primary settlement currency, not several, not a basket, a unique set of circumstances, as mentioned previously, unlikely to be replicated again, has created the dollar's hegemonic position in this big spaghetti of global finance, right? The dollar is here to stay. And the last thing we're going to talk about today, this has been a very long video, but I appreciate you sticking with me, is that liquidity is what makes world reserve currency viable. Both Russia and China are purchasing gold for their reserves to bolster their perception of their currencies, right? They're buying gold to sort of pseudo back it with a hard money and attract capital to their financial markets, right? But they're barking up the wrong tree, right? They want to free themselves from the dollar, but they're barking up the wrong tree. An efficient medium of exchange, like the dollar, doesn't have to be the world's greatest store of value, right? The dollar fluctuates wildly within a range. We saw that DXY chart earlier relative to other currencies, but its spot as the world reserve currency, the world's main medium of exchange, rather, is unchanged. What matters most is liquidity. And China's renminbi has none of that, right? It's measly 2.37% of global trade settlement absolutely pales in comparison to the 40% plus of global payments that are settled by the US dollar. As you can see in this chart right here, the renminbi is the fifth most widely used global payments currency, still a fraction of what even the euro settles. Now, the dollar is king expressly because it attracted global liquidity at the Bretton Woods Agreement, right? This came after a great global monetary reset that was World War II. We'll wrap it up with talking about what we did in the beginning, right? After World War II, the world was in shambles. There needed to be a great monetary reset. The United States dollar stepped in. And since then, the advancement in technology, in financial plumbing, the dollar is thousands, hundreds of thousands, millions of layers deep within this global financial plumbing. And to uproot it would be disruptive, to say the very least. Disruptive, costly, and as of right now, there isn't a reason for it. No amount of gold backing or non-dollar trade networks will change the reality of the dollar's unmatched depth of liquidity. Unless we experience the complete abandonment of all existing financial plumbing, it's here to stay. And that's the reality, right? The dollar genie is not only out of the bottle, but it spent the last 79 years developing a complex global network that relies upon it for daily functioning. And that simply can't be displaced by unplugging the USD cartridge and replacing it with the CNY one or the RUB one, right? Where the dollar has achieved the most liquid market for collateral in the world, the Chinese yuan and ruble appear in less than 4% of global FX reserves. Where the US open capital account attracts all of the world's talent, China's closed capital account and Russia's minimal growth prospects aren't roping in the same capital allocators. The hamster wheel of dollar dominance keeps spinning for now. And that's the reality of it, folks. Thanks again for watching this video. We really appreciate it. Make sure to stick here at the Bitcoin Layer and go to thebitcoinlayer.com/subscribe to not only subscribe to this YouTube channel, but also our Substack publication so you'll get all the latest as it comes out. Thanks again. Take care.